We are 3% away from an all-time high on the S&P 500 futures. Little change. 30 minutes till it started trading. I'm Matt Miller.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
Coming up, tough talk. President Trump lashes out at Jerome Powell again, while Elon Musk calls Trump's tax bill an abomination. Still, global stocks hit a record high as the S&P is within striking distance of its peak, and Wells Fargo rises after being freed by the Fed, while CrowdStrike plummets on an uninspiring outlook. Katie, what are you looking at?
Well, let's talk a little bit more about Wells Fargo because analysts now see new growth opportunity for the bank after the Fed lifted that asset cap that restricted its size for years. You take a look at what shares are doing pre-market, currently higher by about 2.4%, Matt Miller.
All right, I'm looking at CrowdStrike. Those earnings came in really in line with estimates. I mean, 1.15 billion was their projection. 1.16 billion is what the street was looking for. But the company is getting punished in the pre-market, down 7.5% right now, Katie.
We'll dig into that in just a bit, but let's get back to that tough talk because President Donald Trump again going after Fed Chair Jerome Powell after that latest disappointing ADP data dropping at 8:30 this morning. President Trump says that Powell must lower interest rates now as we see weakness in the labor market. To be specific, ADP private payrolls rose by just 37,000 versus an expected 114,000. Bloomberg Washington correspondent Tyler Kendall joins us now from Capitol Hill. He also went on to call the Fed chair unbelievable, comparing us to the European Central Bank. And Tyler, this, of course, sets the stage for what the president's reaction might be on Friday when we get the big, important payrolls print.
Yeah, hey, Katie. Well, he's definitely ramping up his pressure on Jerome Powell, and we have to keep in mind it comes after he met face-to-face with the Fed chair last week at the White House, which the Fed said was on President Trump's invitation. Now, after that meeting, the Fed did say that they did not discuss the trajectory of monetary policy and that anything, of course, is going to be data-dependent, adding in a statement that any decision will be, quote, careful, objective, and consider non-political analysis. Now, of course, President Trump has previously said he has no intentions to fire the Fed chair ahead of his May 2026 chair term being up, but definitely has been piling on the pressure because he wants to see the FOMC ultimately cut rates because, as President Trump has long contended, he thinks lower rates would go hand in hand with his tariff policy. And of course, there's just so much uncertainty around that policy, which makes Fed Chair Jerome Powell's job harder. Now, I did have the chance to catch up with two key senators on Capitol Hill right before I came on to talk to you, Senators Rick Scott and Senator Ron Johnson. Their names keep coming up because they have their eye on the economy when it comes to the reconciliation package. Rick Scott told me that he doesn't blame President Trump and his criticism of Jerome Powell, but Ron Johnson ultimately told me that he doesn't really understand the criticism because at the moment he has his eye on the bond market and says that trajectory is squarely on Congress's shoulders.
Tyler, I want to ask about Elon Musk because in a lot of ways, you know, he's more influential to U.S. politics and maybe to global politics as well than Jamie Dimon. And he has lashed out at Trump's big, beautiful bill, calling it an abomination. How much does this move the needle in Washington?
Well, we're going to have to wait and see, Matt. Of course, it comes at a time when the White House, President Trump himself, is directly picking up the phone to call some of these senators to move them forward. Perhaps this gives a little bit of leverage, a little bit of firepower to that group of Republicans really pitching themselves as fiscal hawks, including Senator Scott and Senator Johnson, as I mentioned, since they want to see some deeper spending cuts. And we did see sort of the same sort of coalition emerge on the House side, but at the end of the day, that package ended up emerging with a projection of adding more than $2.5 trillion to the deficit over 10 years. I also think it's fair to point out, too, that Elon Musk here has been critical of how this plan will speed up rolling back some of those clean energy tax credits, which impact electric vehicles such as Tesla.
All right, that is Bloomberg's Tyler Kendall on the First Buddy fallout reporting from D.C. Let's turn our attention back to this stock market because global stocks just hit a record high as investors navigate trade and growth concerns. The S&P 500, meanwhile, is also on the verge of a bull market from its April lows. Barclays, the latest bank to raise its S&P 500 target for the year. And you look at what's driving it, it's big tech. Just look at NVIDIA. Shares up 45% since April 8th. We'll discuss it all with Bloomberg's cross-asset reporter Alex Semenova now. And Alex, it's interesting. I mean, you talk about bad breath. As long as big tech is in the lead, it's okay.
Exactly, Katie. And it's really been a remarkable recovery. The Magnificent 7 index is up about 30% from April 8th's lows. So investors are really acting like April never really happened. And this is the full effect of a Trump put basically materializing right now. I guess it has a different term now called the taco trade. Trump always chickens out, where he, implements really aggressive tariff policy and then very quickly backpedals on it. And a lot of investors are saying that because he's been so quick to kind of rein in his rhetoric, we actually might not see the full toll of tariffs materialize. For example, Deutsche Bank said that because he was so quick to shift his policy, the estimate on corporate earnings, the impact on corporate earnings is actually going to be much lower than they anticipated, about a third of what they initially expected. So not a huge toll yet on earnings.
I mean, he gets a lot of flack, right, for backing down on tariffs. But even if he leaves the baseline at 10%, keep in mind, that's what has essentially a 10% tariff is what's held U.S. auto producers out of the European market. So it can be effective. Listen, in terms of strategists, they've been all over the place with these tariffs as well. Strategists always chicken out too, right?
Yeah.
What are their targets right now?
Yeah, sell-side taco trade also in effect. Basically, we've seen a lot of flip-flopping, very reactionary responses from Wall Street prognosticators to Trump's policies. We saw Goldman Sachs, Yardeni Research, basically all of the big Wall Street banks lower their S&P 500 targets in April, and now they're back to raising them. Barclays today raised theirs, Deutsche Bank as well, Goldman also raised it, but there's a lot of nuance also in expectations. Barclays perhaps isn't as bullish as Deutsche Bank. They
just
actually
a
say
hair that
just
they
a hair, about
target.
1% from here by the end of December. So I guess everyone's trying to really figure it out still.
It matters. Hyundai raised prices 1%, and we wrote a big story on it.
That mattered.
By the way, you know what else matters?
I'm hoping you'll tell me.
The difference between a cross-asset reporter and an equities reporter here at Bloomberg. They sit on different sides of the row in the newsroom.
In the same room, but still different sides of the aisle.
Alex Semenova reports on equities for us. Thanks very much for joining us. Let's talk about Wells Fargo. It is poised for growth after the Fed lifted its asset cap that was in place for 7 years. That's biblical. We're joined now by Bloomberg's Sally Bakewell, who leads our America's finance coverage. So, Sally, how big is this?
Oh, this is a huge deal. Wells Fargo spent about 10 years trying to put right, remediate, rectify these scandals, which first erupted in about 2016 over its mis-selling of products and opening these millions of fake accounts. And the punishment, it effectively froze Wells Fargo in time. It wasn't allowed to grow beyond its 2017 level of about 1.95 trillion assets, while its rivals all shot up ahead. And it probably lost out on about 39 billion of profits by our calculations. And to put that in perspective, JP Morgan is now 4 trillion of assets, or more than that, and it effectively grew another Wells Fargo in the time that Wells Fargo had the cap.
It's just amazing, and you think about what this could mean for the next few years. You could get excited, but let's talk about the stock specifically, because you are seeing a reaction in Wells Fargo shares this morning, a little bit higher pre-market. A lot of this is priced in, though. Bloomberg Intelligence points out that, for example, since the November election, Wells Fargo has returned something close to 20%, outpacing the KBW Bank Index. So it seemed like people, specifically traders, were anticipating this.
Yes, I think the momentum towards clearing this hurdle has really ramped up, particularly in this year. It was clearing consent order after consent order. We were hearing optimism from CEO Charlie Scharf that they were really close to being able to say that this asset cap has been lifted. And now Charlie Scharf, he can go on the offense. He can really start to grow the bank, which means boosting investment banking. It means boosting trading, which requires a lot of capital to set up desks. And until now, that had not been feasible. It means boosting lending for consumers and winning them back after this brand was tainted. And also boosting lending for companies, trying to attract more wealth managers, targeting credit cards. It's going to be a big challenge, but this is the moment for growth.
I'm just looking at, because Sonali Basak mentioned on our call earlier that they trade at a price to book of 1.5, which, for a guy who went through the Euro crisis, that's a lot. And it's twice what Citi trades at. So their valuation is actually pretty strong.
Yeah, and if you think about the 10 years we've had, it has gone through a pandemic, and it weathered that well. It went through a regional banking crisis and weathered that well. And Charlie Sharfie's kept quite a low profile as they've sought to put all of these wrongs right. So I think, investors probably saw a pretty strong institution. It just wasn't able to grow and close the gap with its rivals.
For context, I meant me. I'm the guy who went through the Euro crisis. And I guess it's kind of inside baseball, because I was actually in Germany for years. And so I'm used to price to book of like a Deutsche Bank in 2016, which is like 0.3.
Yeah. I was also going to say, I mean, that stat might also say a lot more about Citi than it does about Wells Fargo at this moment in time. But Sally, great reporting. Really know that the team has been all over this, long in the making. That is Sally Bakewell. She helps lead our financial coverage for Bloomberg News. Meanwhile, we're about 20 minutes away from that opening bell, so you take a check on futures right now. The S&P 500, the color is red, but it's pretty much flat. Of course, we managed to close in the green yesterday. We were higher pre-market, and then we got that pretty soft ADP print, and you can see that sort of took the momentum out of the pre-market. The NASDAQ 100, a similar story. The Russell 2000, pretty quiet as well. Small caps have been outperforming, but today it feels like everything is restrained.
How's the Dow Jones Industrial Average doing?
I couldn't tell you.
Just type WEI.
That dusty old index.
On the Bloomberg terminal, up 214 points yesterday to 42,519. So also within striking distance of an all-time high. Speaking of striking.
Yeah.
CrowdStrike. The outlook disappoints. It wasn't really that bad, and nonetheless, investors are punishing the stock. We'll talk about the cyberspace next. This is Open Interest. Let's get out of high interest and look at what's making headlines around the world. China is considering placing an order for hundreds of Airbus planes as soon as next month. The deal could involve around 300 planes, including both narrow body and the good ones, the wide body models. The deal would help cement Airbus's dominance in the Chinese market. It would also be a significant blow to Boeing, which has struggled to make sales in the region thanks to, obviously, those trade tensions. A ship carrying about 3,000 cars to Mexico was abandoned in the middle of the Pacific Ocean after catching fire yesterday. The U.S. Coast Guard evacuated all 22 crew members, transferring them to a nearby merchant ship. The Morning Midas was also carrying about 800 EVs on board. In recent years, there have been a handful of significant blazes involving vessels hauling EVs, prompting concerns that the batteries inside those cars are vulnerable to fire risk and can lead to major disasters. They're really hard to put out. And Hewlett-Packard Enterprise reporting quarterly revenue that topped analyst estimates and indicating the tariff impact this year won't be as bad as originally thought for that company. Artificial intelligence has fueled a wave of demand for powerful servers and other hardware from HPE and other players like Dell as well, and Katie's super microcomputer.
Very interesting. And of course, HPE reported results last night. So too did CrowdStrike, and it's falling in a big way despite earnings beating estimates in the first quarter. Its unchanged full-year revenue outlook, however, was seen as a negative by some analysts, with Evercore and Canaccord, downgrading the stock. Bloomberg Intelligence Global Head of Tech Research, Mandeep Singh, joins us now. So, Mandeep, this is an interesting one because everything was okay. It just seems like this was a case of really high expectations.
Yes, I mean, the multiple has rebounded since their global outage last year, which really did reset expectations, but they have executed well, and some of the metrics like gross retention was solid. They're talking about a second half acceleration, but they didn't change the guide. And that's why, you see the negative reaction. But to me, the big picture here is cybersecurity should benefit from all the AI deployment. When you look at the data that is being used for training these models, the inferencing, how everyone is excited about AI agents, everything involves a layer of cybersecurity. So from that standpoint, you would expect a category leader like CrowdStrike should see an uptick in growth. That didn't come out last night. They talked about second half acceleration, but AI wasn't a big piece of it. And I think that's why investors felt a little let down.
Well, putting AI to the side for a moment, which is hard to do, There's also just the fact that there's so many cyber attacks still. It feels like it's the new normal. You think about Victoria's Secret this week, for example, having its own outages.
Wait, what? What happened?
Yeah, Victoria's Secret had to delay its earnings because it's dealing with outages. Don't get too excited over there. But Mandeep, I mean, just the fact alone that this has become a reality for a lot of companies, shouldn't that be a long-term growth story for CrowdStrike?
There should be, but one thing that's unique about cybersecurity is the attack vectors keep changing. Like you may think it's a certain type of attack, a company is really good at protecting against it. Next time it will be a completely different type of attack, and that's why it's a very hard problem to defend against. But that being said, you know, Google has announced this acquisition of Wiz for $33 billion. To me, that is where security is going, cloud, browser security. And when I look at, you know, a CrowdStrike, which has to now compete against a Microsoft and a potentially Google closing that acquisition, that is where the pure play companies have a tough task ahead of them, because look, in the end, Microsoft and Google can bundle cybersecurity and everyone will end up using their cybersecurity products because of the bundled offering. So that's the challenge that all the pure play companies have, even though CrowdStrike is a category leader in the endpoint side. But a security attack is never just about endpoint.
Right.
It's all these different vectors that could come into play.
I want to ask about Apple. I was surprised when I typed ANRGO on the Bloomberg terminal, and I saw that there are actually 23 holds and sells on this stock. I mean, I figured everybody would have a buy. Apparently, Laura Martin over at Needham has also downgraded the stock. What's the problem at Apple?
Well, everyone feels they don't have EPS growth without a proper refresh cycle, and the refresh cycle keeps getting pushed out because their AI play is not clear. I mean, when you look at all the other Mag 7 companies, they're going big when it comes to AI investments, data centers, large language models. Apple so far has been watching from the sidelines, although I would say they have launched Apple Intelligence. It's just they haven't invested big in terms of CapEx dollars.
Right.
And that's why market is underestimating their, AI prowess. But with that being said, I still feel when it comes to distribution, if you need a personalized AI assistant or anything personal that touches, AI agents, you need to do that on Apple's platform. Where else would you do that? So in the end, they will find a way, but they don't have their own large language model. They're not investing big CapEx dollars, and that's why I think people are slightly negative when it comes to their prospects.
Well, all these problems build on themselves, it feels like, because you say that, the sell side is underestimating the AI capabilities here. It seems like consumers are as well, because as Laura Martin said, this stock needs an upgrade cycle. They don't see it happening because it seems like those AI features aren't enough to entice people to actually upgrade their phones.
And the other thing is the supply chain. I mean, look, the tariffs keep coming back into picture time and again, and their costs have gone up. They quantified that $900 million tariff impact. So that could be even bigger. I mean, $900 million, we could be underestimating that given all the tariff talk. So the supply chain aspect is huge. But in the end, they have that lock-in with the consumers. Like, nobody wants to move out of the Apple ecosystem. And the barriers to entry for anybody coming up with a new device, even though OpenAI has talked about a new device, it's so hard to replace Apple ecosystem given so many devices that they have with the consumer. So that's the hard part.
We'll see what OpenAI and Johnny Ive come out with, because no one knows, but very interesting. Mandeep, great having you on the program as usual. Mandeep Singh there from Bloomberg Intelligence. Check out his work by typing BIGO on your terminal. Katie, it's always interesting when we have someone famous in the building.
Yes.
And I look over here, I see Andrew Slimmon
sitting
Morgan
to
Stanley.
our left.
This guy has crushed it. I mean, global stocks at an all-time high, U.S. stocks 3% away, and he is beating in the funds that he manages both of those
Do you think he'll come on TV with us?
indexes. Yes. Coming up, Morgan Stanley's Andrew Slimmon. He warns of another drawdown, but just this summer. So is that an entry point before we swing back up? We'll ask him what cracks he's seeing in the rally. This is Open Interest.
All right. Barclays is the latest bank to raise its S&P 500 price target, saying that peak trade uncertainty has likely passed. Barclays joins a growing number of firms upgrading their S&P 500 forecast after cutting earlier this year. Let's discuss with Andrew Slimmon. He is Senior Portfolio Manager over at Morgan Stanley Investment Management. Such a treat to have you on set with us. And let's talk a little bit about the trajectory of the rest of the year, because clearly you have some firms coming out, raising their targets up just a little bit, but you think that maybe the summer could be a little bit of a disappointment.
Well, it's hard to get optimistic now. The market's up 19% off the low. The time to get optimistic was in April. Easy to say now in hindsight. But look what happened. We started the year with the average price target was 6,500, a 16% return. A lot of optimism. You have a drawdown. Everyone takes their numbers down. Now they're taking their numbers up. So as a contrarian, and you're coming into the summer. I think second quarter earnings will be good, but then you always get kind of this lull between end of July and mid-September, and that's I'm nervous about that because I see a lot more optimism as we started the year. Now we're back to that level. That gets me a little nervous on the summer. And overall, my view has been, we can get into this, is the third year of a bull market, which is from, fourth quarter of 2022, was the first year, second year, 23, and so forth. The third year, is not a great year.
Right. But bull markets don't die of old age, right? So the question is something going to kill this, or do you buy in October when the third year is up? Andrew Slimmon is going to stick around to answer those questions and so much more. A check on futures ahead of the bell. Katie, what are we looking at?
Here is the setup as we skate into the opening bell. It's pretty quiet, but the colors are green. The S&P 500 up just a hair. A similar story if you take a look at the NASDAQ 100 and the Russell 2000. Let's see if there's any fireworks to be found at the opening bell. Up next. This is Bloomberg.
Moments away from the start of trading, this is Bloomberg Open Interest. I'm Matt Miller, and we're getting ever closer to 6,000 again on the S&P 500. Futures are higher right now, only 0.1%, but this market wants to rally. I said that yesterday, and we're now only 3% away from an all-time high. You hear the opening bell on the New York Stock Exchange. I believe Forbes CEO is ringing the opening bell with some editors at large. What does that even mean? What's an editor at large?
We seem to have a lot of them.
Not a lot of jobs get that kind of freedom. At the NASDAQ, AWS hoping for a unicorn. Celebrating the opening bell with a bunch of startups. Amazon stock is only up 67% in the last 5 years. I was really surprised by that.
Yeah, it is surprising. It's underperforming the S&P 500 over that time frame. It certainly hasn't felt that way. Shall we talk about Wells Fargo?
Yes, big story.
Let's talk about Wells Fargo. Analysts seeing new growth opportunity for Wells Fargo after yesterday when the Federal Reserve lifted that asset cap that has restricted its size for about 7 years. Gains of about 2.5%, which doesn't seem like a huge move. But Matt, as we were talking about with Sally Bakewell, a lot has been priced in since Donald Trump won the presidential election back in November.
All right, so we're going to continue to talk about that throughout the program because it's such a huge deal. I mean, 7 years is a biblical amount of time. And as Sally Bakewell told us, some companies like JP Morgan have grown one full Wells Fargo in terms of assets since that cap was put on. CrowdStrike, obviously, it's a much smaller company, about half the size at $120 billion, but it's shrinking today because while earnings came in line with estimates and the outlook was pretty much bang in line, the street is not impressed. They said they're going to have $1.15 billion in sales. The street wanted $1.16 billion in sales. And this shows you how much you get punished for missing in a quarter when so many people beat. We're back here speaking of that with Andrew Slimmon. He's a senior portfolio manager at Morgan Stanley Investment Management. And Andrew, one interesting point that you've made is that in the first quarter, companies beat estimates, and yet analysts are still lowering their full-year targets. Why?
Because of I think it's a great setup. I think that's a very that falls into the bullish ledger, which is just to be specific, first quarter earnings beat by $3.50. So in theory, the full year number should go up by 350, but the full year number went down by $10. Now that's consensus for the S&P because yes, it was good, but we all know it's going to get bad in the future. Well, what happens if it's not as bad? And so this is the concept that is, I think, is important, which is the hard data is telling you something, but a lot of experts are saying, yeah, but it's going to get bad out there. And if they're wrong, I think you're going to see a chase into the end of the year in terms of people raising their numbers because so far the data hasn't supported this pullback in earnings estimates.
Yeah, on the benchmark level, you've already seen that. Barclays, Deutsche Bank, Goldman coming out in the past couple days. I will note that the S&P 500 now is up 20% intraday from its April low. So if this holds, set to close in a bull market. And with that being the case, Andrew, are there still bargains to be found out there? When you talk about this great setup, are there still discounts or have we rebounded?
Well, I mean, back to Matt's point, which I think is really important, which is, look, can we find companies where they really blew out the number in the first quarter and yet their full year number went down? Right? And Amazon would be a great example of that, right? So there are a host of companies that really reported great numbers where analysts are too negative on the full year number. So that's where, I think the market's giving you an opportunity. Anytime stocks diverge from their fundamentals because something's going on, Washington, D.C., blah, 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 that creates an opportunity because ultimately stocks move with earnings.
So far it's been in the AI rally, the picks and shovels, right? Or the gear, the chips, the servers, as we were talking about this morning. But it hasn't been the companies that are making money on their AI, say, software products, for example. We were talking about this yesterday with Bruce Richards. He's bullish, though, that those companies are going to absolutely dominate. When does that happen? When do we see the
100%.
ROI?
Completely agree with that. Go back to when we rolled out, when the Mosaic browser was rolled out in '94. Well,
Katie?
No. Unfortunately, I do.
Sounds exciting, though.
So, but the internet really wasn't embraced until 97, 98, and that's what caused that big boom in the market in the late 90s was the productivity enhancement. So I think it's a lag, and that's why I think this year is just a pause year. But I think you're going to see this big productivity boom that happens starting next year as companies start to embrace this, because at the end of the day, let's face it, AI doesn't have a healthcare cost. It is saving money for companies.
I will never forget in the year 2000 when my colleague Andrew Bulkley told to me in the Frankfurt office at Bloomberg, just Google it.
Just Google it.
And I was like, what is that? What's a Google?
That was the
I had
first
no
time.
idea in the year 2000 what Google was.
That's pretty amazing. I also didn't know what Google was in the year 2000. But I want to talk a little bit here about, so it sounds like you see this productivity boom coming next year. There's a bit of a lag, but it's coming. So what do you do until then? Do you just hang out in your money market fund and be happy?
Well, I mean, yes and no. I mean, now maybe a little bit more so than a month ago or a month and a half ago, because I think at the end of the day, the market will end the year higher, just not substantially higher. But if I say to you, Katie, look, the market's going to be up 4%, 5% this year. Well, the market's not going to go up a little bit every day. There's a lot of volatility, and lo and behold, in low returning years, you tend to have more volatility. So that gets back to the point of, do you tack against the headwinds? So I think it's unlikely that the volatility is over. I think we'll make an all-time high. I think second quarter earnings are going to be pretty good, and then we're going to get to this pause period, and that's what gets me a little nervous about later. And so volatility can be your friend.
What's your funds, as I mentioned at the top, the Global Concentrated Fund, MLNIX, and the U.S. Core Fund, MUOIX, have outperformed pretty drastically this year. I mean, you beat global stocks by 40%. You've doubled more than the S&P 500. What's your process? Do you look at history? I mean, you were talking about the length of a bull market. Do you go bottoms up? I mean, what do you do to win?
Well, I think we put too much emphasis on the ability to predict what's going on from a macroeconomic, and we don't focus enough on the behavioral aspects. This is the only business I know, Matt, where when prices go down, people sell. And when prices go up, people buy. And so as a core manager, I don't know if that's going to be in growth or value or financials or technology. I don't know. But I know people will react poorly. And so as a core manager, whether it's globally or domestically, if we can tack against the wind, that's our advantage. And I'll give you a perfect example of what I mean. When the market was down, close to 20% in early April, everyone was buying the safe stocks. It's like, well, they've already worked. The market's down 20%. So that was a time to get more aggressive. Now, as a long equity manager, I think it's a time to, okay, maybe I want to own a few more of those defensive stocks to protect the downside. So I don't know what's going to work. I just know that behaviorally people will consistently kind of move to what's already happened. And if we can tack against that, that will generate good returns.
All right, Andrew, that's a good place to leave it. Hope to see you again in studio soon. That is Morgan Stanley's Andrew Slimmon. Meanwhile, let's get a check on this market. Of course, set for a bull market. Like I said, if we hold at roughly these levels right now, we're just below 6,000 on the S&P 500. And if you take a look at the breakdown of how we're getting there, it's kind of an even split when you take a look at the numbers of gainers versus losers. You have almost 270 names in the S&P 500 in the green right now, a little less when it comes to the red. And then you take a look at the individual names. You have Broadcom, Meta, Nvidia, Apple, all leading the way higher when you take a look at the points contribution here. That's what you want to see. That's what's getting us to closer to those all-time highs. On the downside, you have a big weight when it comes to CrowdStrike, as we've been discussing. Investors not really loving the earnings that they delivered last night. You also have Philip Morris and Tesla, Palantir, et cetera, there. Let's take a look at how this looks on the sector level, though. Like I said, pretty much an even split, a little bit more green than red, though. Communication services at the top, healthcare, too, in second place. Eli Lilly having a big day, and then big tech coming in. You take a look at the bottom, and you do have some laggards today. Consumer discretionary real estate. Then it gets a little bit more real when you take a look at consumer staples and at utilities, Matt. That sector currently off by about 1%.
Well, that's a good time, I guess, to buy in that case, right? According to Andrew. I mean, especially since that's one of those defensive sectors, but utilities had a pretty good run yesterday with Constellation. Coming up, from extreme weather to supply chain uncertainty, taking precautions is more critical than ever for this, business owners, I guess, in this environment. We're going to get insights from Pat Gallagher. He's the CEO of one of the biggest insurance firms that you've never heard of. Gallagher's chairman and CEO joins us next. This is Open Interest.
Welcome back to Open Interest. It's time now for our top calls. Some of the analyst action in focus this morning. And first up, a big call out from Needham on Apple getting downgraded because of growth concerns and because of its position in the AI landscape. The analyst over there, Laura Martin, writing that, quote, for this stock to work, it must have the catalyst of an iPhone replacement cycle, which we do not foresee in the next 12 months. Apple shaking it off a little bit this morning. Next up, we have Snowflake getting raised to a buy over at UBS thanks to an upcoming investment cycle. The software company gave a strong outlook for quarterly sales after launching a number of new products over the last year. And finally, we have Taco Bell and KFC parent Yum Brands getting upgraded to a buy over at Goldman. The firm cites its best-in-class growth versus its peers, and Goldman actually sees 16% upside in the shares, which are currently off by about 0.4%, Matt.
All right, let's talk about a big growth business that you may not have heard of. Insurance firm Gallagher released its annual business owner survey. The results finding owners are taking extra precautions to safeguard their businesses, many growing increasingly concerned about extreme weather. But there are a lot of other serious concerns like supply chain, obviously, and cyber attacks more recently. Pat Gallagher joins us. He's the chairman and CEO of the company. And Pat, before we get to that, I got to ask about your growth, because I'm constantly astounded when I look at these charts. Over the last 5 years, you're outperforming massively. Over the last 10 years, you're outperforming massively. I look at the analyst chart, and their price targets are consistently under where your stock is going. Why do you think people underestimate Gallagher?
You know, it's a really good question, man. I don't know. I think people, in general, don't have a real clear understanding of insurance. And that's one of the reasons I appreciate an invite like this. There's a lot of people that just think of insurance as kind of a tax on what they do. And what you really don't realize is how important it is. I always make the comment that people don't realize insurance is the oxygen of commerce. You don't have insurance, you don't breathe, you don't do anything. You don't send a container somewhere, you don't buy a car, you don't build a house, etc. And when you look at that, then you realize how important it is, and business owners get that. There's no question about it. They know that once they write a business plan and buy a truck, they buy insurance, and that's because it's their family money. And they're concerned about what's going on out there. And when we do our survey every year, and we talk to 1,000 of these owners, you can see clearly that the concerns that come through touch right on risk management and insurance.
Right.
So what are you concerned about? Weather. What do we take care of? Weather. And the insurance industry steps up in these environments and really makes a difference. You've got about $200 billion of catastrophe loss monies that are going to be paid in the United States alone in a year. That's a huge spread of risk. And what that really means is that for those companies to have stability, they need proper coverage. And as that becomes more and more important, people like ourselves are advisors. We don't take risks. We're a broker. So we help that client work through if it's supply chain, if it's weather related. They'll even ask us for advice on where to relocate. If they're seeing, I just can't take another hurricane and keep my business alive.
I got to get out of Florida.
Well, or position yourself somewhere else in Florida. Florida's important. So it's all those things are very nuanced. They're very important, and it's incredibly important that people realize we're not just selling insurance. Of course we sell insurance, but we're also advising on all the things you should be doing to make sure your risk profile is better.
You have 57,000 employees, right? Or at least you did at the end of the year. And I'm looking at the stock. It's up 800% in 10 years. So you've taken this business from, I guess your grandfather started it, 500 years ago, and now you've
100 years ago.
Now you've grown it. I mean, exponentially. What is your process? How do you do that?
Well, I think the thing that differentiates us is there's a couple of things that are big differentiators. Number one, we really are a composite of acquisitions. There's 30,000 agents and brokers in America, and I'm very clear about the fact that we're not a roll-up company. We're building essentially a business together with partners who have done well in our business locally. When they join Gallagher, they get a whole composite of new tools. Data and analytics are becoming much more important. The relationship with carriers, what we have in terms of expertise relative to the very verticals they're in, whether it's construction, religious, not-for-profit, real estate, et cetera. People want to trade with people that understand their business. So what you've got is these 30,000 entrepreneurs who, by the way, do well. If they combine together, bringing their brain power to what we have, it makes the whole enterprise stronger. And I think our biggest differentiator, frankly, is our culture. We like each other, we work together, we come 100% behind helping a client. And everybody gets that. And so over and over, we buy somebody and they'll say, yeah, I'll be here for about 3 years, I'll sell you the business, but count on about 3 years, and 7 years later, you say, how you liking it? I'm still here.
Well, let's go back to this survey, this annual business owner survey that you launched. You talk about some of the concerns there. Extreme weather, for example, is one. But at the top of the list, I thought it was interesting to see cyber security up there. We were just talking about Victoria's Secret, their cyber issues this week. But it's across every industry, it feels like, these cyber attacks.
So very clearly, I've been saying this now and that's one of the examples of how the insurance industry is so dynamic. We never talked about cyber 15 years ago. I heard you in your previous segment talk about Google. 2020, you didn't know what it was. Today,
2000.
2000.
Yes,
sorry.
2000.
2000.
By 2020, I was already addicted.
You were there. You were there. Sorry, man. But the truth is, if you're running just a little store, bodega, you should be considering cyber cover. And it's that critical to the long-term safety of your company. And people need help with that. What is cyber? What does it include? Well, it includes the help you get after you've had a problem. And that can hit anybody from a small trucking firm all the way up to the likes of Victoria's Secret.
Yeah.
And even if you're Gallagher at 57,000 people and you have a breach, you need a tremendous amount of assistance. And that's a big part of what the product brings. And I think it's good to finally see it making the radar screen, because we've been telling our clients, and there was a time when we were frustrated. We had said to ourselves, every single client will be talked to about cyber. And about 16% a decade ago were buying it, and that's ramping up incredibly now.
It's a great point, too, that, I mean, okay, it's one thing for Victoria's Secret to have a cyber attack and have to deal with it. It's a totally another thing if you're a small company such as a bodega. Running up against the clock here, unfortunately, I have to leave it. Really great to see you, especially in studio. Our big thanks to Gallagher's Pat Gallagher. Now coming up, Dollar Tree, warning of a profit hit from, you guessed it, tariffs. Details next. This is Open Interest.
This is Bloomberg Open Interest. I'm Matt Miller. Quick check on stocks as we approach 6,000 on the S&P 500 again. Right now, 59.86, 59.87, up 0.25%. The NASDAQ gaining about as much as well. A lot of red on the screen for a green day. Crucially, NVIDIA is only down 0.1%. Tesla off more than 2% as Chinese shipments disappoint, down 15%. CrowdStrike, we've been talking about, kind of missing its outlook. And then Dollar Tree, we're going to talk about right now. Katie, what do you got? Let's do that. Dollar Tree warning of a profit drop due to tariffs despite adding more than 2 million new shoppers last quarter. Now, the retailer anticipates a re-acceleration in sales to close out this year. Let's break it all down with Bloomberg retail editor Emily Cohn joining us now. So let's compare and contrast here because we got Dollar General yesterday. Shareholders seem to like the fact that they were kind of mitigating and navigating these tariffs. A different story when it comes to Dollar Tree.
For sure. So Dollar General is not your typical dollar store. It's much closer to a grocery store. I think something like 80% of its sales come from consumables, things that you eat. Dollar Tree is much more your classic dollar store. And what that means is that they're way more exposed to tariffs, the stuff that's coming from China. China's its #1 source of imported goods. So that puts it at, in a much weaker spot than a store like Dollar General.
So what do they do? I mean, do they become the $5 store?
There are some pluses and minuses in this report. I think they're saying that more people from upper income families are coming to shop. I think they probably saw a little bit of a pull ahead of people shopping ahead of tariffs.
But they can't raise prices much, Emily, right? Because isn't the idea that everything costs $1?
That's true. That's true.
Or is that
but
not the idea?
They've moved away from that $1 price tag a little bit.
They can probably raise prices a little bit. They can probably, like Dollar General, negotiate a bit with their vendors. There's some other mitigation efforts there. But yeah, you can't raise prices that much if dollar's in your name.
That's true. We only have less than a minute left with you, but bring us forward to after the bell today because we have Five Below to kind of close us out here.
Five Below is also in a similar spot as Dollar Tree.
Again, locking themselves in on a price with the name.
A little bit more.
It has to be below five, right?
That's true.
But yeah, we saw in April they turned around a shipments of goods coming from China. They're much more dependent on China, and I think we'll be watching for that and how they're planning to mitigate the cost of these tariffs.
All right, Emily. Every time a store that sells stuff for only $1 or less than $5, we're going to call you back. Emily Cohn there talking to us about today, Dollar Tree. Coming up in the next hour, Ann Miletti of Allspring sees opportunity in healthcare stocks. We've seen a lot of M&A there this year. We also have the CEO of the jeweler Kendra Scott on the rise in gold prices, and that rise doesn't look set to stop as central banks continue to buy. Plus, Citizens CEO Bruce Van Saun joins us at the desk to give us the look from a bank that operates on Main Street. This is Open Interest. We are 30 minutes into the trading day and pushing towards 6,000 on the S&P.
The moment we've been waiting for. We are looking at bull market territory. They are back. We've been talking about it. The bears are now hiding, it seems like, for now.
Yeah, we're just less than 3% away from an all-time high. That was 61.44. I think we put it at the end of February. And globally, stocks are at an all-time high. So.
Yep, and it's interesting because the yields are lower today on the heels of softer economic data, and it actually
didn't even look yet today.
Like we are looking at even more soft economic data. So we're going to bring in our own Michael McKee to talk about that. We're looking at ISM services looking like it's coming in lower than expected.
It's coming in a lot lower than expected. We're in contraction territory here at 49.9, down from 51.6. This is a surprise. The feeling was that it wouldn't be changed during the month at all, go up just a little bit. The other numbers are not particularly good either. Prices paid rises to 68.7 from 65.1, so you get some inflation at the same time that you get a contraction in activity. Production 50 goes to 50 from 53.7. New orders falls into a big contractionary territory, 46.4 from 52.3, and employment rises just a little bit, 50.7 from 49. So we'll see how that feeds into what we get on Friday. But the interesting thing, of course, earlier today we had the ADP number come in as a big surprise, only 37,000 jobs. Not saying ADP is a great forecaster, but
I wanted to ask you about that.
Low.
And I guess probably 3 or 4 times a year I ask you, hey, Mike, how important is ADP as we head towards the non-farm payrolls number on Friday?
Well, ADP is not particularly important in terms of its overall number, but in terms of the direction, it kind of gives you some information. It might get incorporated a little bit into tomorrow's or Friday's forecast.
But it's not super predictive.
But in April, ADP said there would be 60,000 jobs created, and there were in the private sector, and there were 167,000. So you're not going to get much of a steer from them. But they do get traded on a lot, so people pay attention to it.
All right, Mike McKee, thanks so much for joining us, our international policy and economics editor. And Sonali, I hadn't even checked the yields today. You didn't remind me this morning, and we're below 440 or right there on the 10-year right now.
And it's interesting. The latest data that we just got at the top of the hour brought yields even lower. Interesting to see how this push-pull is going to play out. I know later in the hour we're going to talk about that tax bill. So the long end being lower is kind of interesting with that
Elon Musk doesn't like it.
Doesn't like
apparently.
it too much,
And he's pretty important. Also very important in these markets, Ann Miletti. She's the head of equity investments at Allspring Global Investments. And Ann, I got to ask you about the bullishness here. I mean, we've now entered an official bull market, as Sonali pointed out, right? So we're 20% up from the bottom. We're 3%, 2.5% away from an all-time high on the S&P 500. Globally, stocks have hit a high. What's going on? Aren't we worried about the tax bill, as Sonali said? Aren't we worried about the tariffs? Isn't there so much uncertainty?
I mean, there is a lot of uncertainty, and I feel like we've had some overcorrection in both directions, right? We had a lot of fear driving the market to the downside after Liberation Day, and then we've had this kind of what I would call maybe a quick, sharp overcorrection on the upside, where people have quickly gotten comfortable with, tariffs won't be as bad as we expected in the beginning. But I would say policy uncertainty remains, and there's still a lot of things that we need to work through. So while I, still encourage investors to remain invested, where you are invested, I think will matter. And I like to tell people, you got to be comfortable being uncomfortable because, I think we're going to get a little uncomfortable here.
So what does this mean in terms of where you see the S&P going near term? We were talking about a little earlier, heard you and Katie talking about strategists revising to the upside. But if you think that we have corrected too much to the upside, are you still worried about a drawdown before we revise higher?
Yeah, I will never get timing perfectly correct, right? So whether or not this continues, I don't know. But what I would suggest is that there are places in the market that haven't that have maybe been ignored more than others. And those are the places where I'd pay more attention to. Focus on diversifying your portfolio and making sure that you're thinking broadly about risk versus reward instead of being in areas of concentration and areas where there's greater speculation.
I want to ask about the tax bill because Elon Musk has come out and really railed against it. You could say, okay, there's a lot of theater, right? These are very dramatic people. They like to get the headlines. They're all about the changing news cycle. But you could also say he got President Trump elected. I'm not sure how right you would be, but he's been incredibly influential,
He's also
right?
giving fuel to the people who want to vote against
Exactly,
this tax bill.
exactly. So you could use Elon Musk as cover to go against Donald Trump. How closely are you watching this?
I mean, I think the tax policy is critically important. You know, there was a lot of focus on tariffs, and it felt like, you know, the market could kind of focus on one thing at a time. It was tariffs, and now it was kind of a slow shift, but now the shift is a little bit more on tax policy. I think, you know, I'm not an economist, but when I look at all of the reports out there, if we don't get a tax policy passed, the impact on GDP is at least another 1%. So it's significant. It's just as big in some ways as the tariff impact. And so to the impact on growth. So it's critical. I think, you know, what we're seeing now is politics in real time and negotiation in real time, and we'll see where that turns out. But to your point of how did we get here, and are we a little bit too frothy based on everything that needs to settle out, that's kind of where my gut is, right?
What are some of the more important parts of the tax bill to you? Ultimately, there's the level of taxes, but then there are the fine-tooth comb details, right? We talk a lot about Section 899, for example, this idea that foreigners...
Maybe not enough.
Yeah.
The revenge tax.
The revenge tax. People are really worried about it, particularly bond investors. Is it something that concerns you?
Yeah, you know, it's funny. I like to take the focus out of what I'm concerned about, because I think one of the best things I can do and investors can do in this market is not put any emotion in what's going on, but say, okay, like, if I take emotion out, what are the equity markets focused on and what are the bond markets focused on? And I would just say, as an equity investor, I'm a little bit more focused on what the bond markets are telling us here about the potential implications of this tax policy. And I can't ignore that as an equity investor, even though, you know, the market is kind of climbing higher. And so that's where it gives me some pause. And I do think there is real risk. There will be trade-offs, there will be some challenges. And, you know, that issue that you point out, I think it's just another point that gets put in the negotiation of, you know, whether it's tariffs or trading, like what's going on in the background that we don't know about.
You know, it's interesting. Going back to your thought here on Elon Musk and how he sees the tax bill, I will say the one thing he's not influencing is the bond market. You do have yields lower despite all of the bell ringing that's going on X
but
right
I was
now.
going to say, maybe that is because of Elon Musk. Maybe the fact that he's giving cover to those who could vote against the bill means bond traders aren't worried about Section 899 because it's not going to pass. And that's why we see the 10-year down 7 basis points right now. Anne Miletti, great having you on the program. Thank you so much for joining us. She is head of equity investments at Allspring Global Investments. I want to get a look at some of the single stock movers this hour and kick it off with one that's incredibly important to Sonali and to, I would say, a large base of our viewers. Wells Fargo rallying not quite as much now as it had been, but I think it is, I've been using the term biblical, right? Because it's been 7 years that they've been under this cap, and it is now lifted. And Sally Bakewell told us a bank like JPM has grown an entire Wells Fargo since that cap was put into place.
It's absolutely incredible the amount of business they've lost over the time of the cap. They are now unlocked. They are unleashed. But the challenge for Charlie Scharf is really interesting here, getting deeper into investment banking, into trading against the giants. So I would say the competition is on. A fun fact about the price to book value there for Wells Fargo, not only are they about double Citigroup, they're actually more than Bank of America.
We have a chart. I believe Joe put a chart together. This is just the two, Wells Fargo and Citi. You can see Wells Fargo at the top, 1.5 in terms of price to book. Citi only 73 basis points, I think.
Yep.
It's interesting, though, if you put in Goldman Sachs,
Just
which is
over.
like 170, and then JP Morgan, which is like 2.25, right?
Incredible.
So, yeah.
But
you really got me into these banks, Sonali.
Oh, I'm loving that is the case.
Thank you very much for that.
Anyways, we're looking at CrowdStrike as well. Cyber has been a really interesting part of this market. They have fallen after a disappointing outlook and multiple analyst downgrades. And HPE, what do you call it?
Hewlett-Packard Enterprises
says it expects a reduced impact from tariffs on its businesses this year. It is up, but only marginally, about 0.1%. Now, coming up, PE power players. We're live from Superreturn with Steve Wise, Carlyle co-head of America's corporate private equity. This is Bloomberg Open Interest.
Right now, while the tariffs and Liberation Day got a lot of the headlines, the market forces, the so-called Bob vigilantes, have woken up those to the concern about the growing deficit in the United States. So in the marketplace right now, with a little bit slower growth and some concern and a lot of hand-wringing, the deficit issue has taken the main stage versus the impact of the tariffs. Now, this administration, we can't get too comfortable. There can be a headline in the next few minutes to change that. But right now, the big focus is on rates and the deficit, obviously, as the current administration is focusing on their big, beautiful bill.
Now, Apollo President Jim Zelter speaking to Bloomberg earlier from the Superreturn conference in Berlin. Carlyle's David Rubenstein expressing the same sentiment last month, saying that tariff concerns are likely to fade from view by the midterm elections. We're going to head back to Berlin, where our own Danny Berger is standing by with another guest from Carlyle. Danny, take it away.
Sonali, thank you so much. That's right. I am here with Steve Wise, the co-head of American Private Equity at Carlyle. Steve, thank you so much for joining. Really great to see you.
Thanks, Danny. Happy to be here.
So, I mean, it is this moment of incredible volatility where you have policy volatility in markets, but we've done a round trip and then some, and at least public equities. Are we too sanguine about this moment of stress? Are we whistling past the graveyard?
Well, it's an interesting observation. I think I'm a little bit surprised the market is up where it is. The S&P 500 is up over 5% since April 2nd, and EBITDA multiples are close to 15 times, which is really just a turn lower than the all-time highs in 2021 and really all-time highs in decades. And personally, I don't think we have the clarity to be at that level right now. We really look at the data. You know, Q1 was solid. If you parse out some of the inventory noise, the economy grew at 2 to 2.5%. And April and May so far seem reasonable, pretty benign. Inflation's in a reasonable place. I think some people thought we'd have higher inflation from reaction from businesses. Unemployment is in a pretty good place. But there's a lot of noise around shipping data from China, down a lot into ports into Los Angeles, but in some ways diverted to other parts of Asia and still making its way to the U.S. So it's hard to parse through that. We look at the consumer data as well. That's very important. That's been very choppy. Sometimes the consumer's more confident, sometimes it's less confident. I feel like it's really almost following the volatility in the stock market.
I mean, that's such a hard environment to do business in, with the uncertainty being the buzzword, with uncertainty about consumer trying to understand the data. I know you just had a forum where you met with many CEOs. What is the sentiment? What did you hear from them?
Yeah, we just, fortuitously, we had a forum with our CEOs, about 40 of our CEOs just a few weeks ago. I think the reaction back then was, wow, just trying to understand the magnitude and the severity of the tariffs. It kind of caught a lot of people off balance. But in the last few weeks, they've had a chance to catch their footing. I think a lot of CEOs, certainly our best CEOs, have found their footing in this moment. And they've kind of gone through a playbook. You know, the first thing is assessing the risk. You know, for those that have direct tariff risk, what is that and how do you assess it? That's been done. That happened in a few days. Then it's how do you shore up your supply chains? How do you find, get vendor concessions, alternate supplies? A lot of that's been done, and some price increases to the extent you can do it. The third thing that they've done is look at their balance sheet and their liquidity and make sure they can endure, you know, what could be another change to the tariff situation. And it's also a really good time to find a way to cut costs. It's hard to cut costs in really ebullient times, but in times like this, it's an opportunity to tighten your belt. The fourth thing that they've done, and the most important, is staying close to the consumer, the customer, and seeing what the customer wants and what the customer needs. A lot of our company's competitors had a haphazard reaction to the tariffs and increased prices very quickly, which really made customers upset. A lot of our better companies didn't do that. They talked to their customers, they figured out what was needed, and they're able to take a lot of market share. So that was, hugely important. And the last piece is just investing in their business, being more aggressive and being having their foot on the gas when others are retreating.
That's interesting, because what we've heard from a lot of businesses is now is the time to pause, to not be spending capital, to wait things out. Is that not what you're telling your CEOs to do? You're saying go full forward and now is the time to invest in yourself?
For companies that have a lot of tariff exposure, and that's a very small part of our portfolio, we want to make sure those first things that we said are in solid shape first. But for a lot of our companies, which are service-based, U.S.-only based, which are in technology, they're in healthcare, they're in financial services, they don't have a lot of direct impact. We're asking them to lean in and be aggressive while others are retreating.
So in Carlyle's last earnings, analysts really lauded it as the return to growth for private equity. There was a lot of excitement, but within that, Harvey Schwartz talked about this idea that we're not in a red light environment, a green light environment, but a yellow light environment. What does it mean to grow Carlyle's private equity business in a yellow light environment?
Well, in a yellow light environment, we are leaning into our power alleys. We're leaning into areas where we have strength. That's healthcare, that's financial services, that's technology, that's aerospace, defense, and government services. As you know, our heritage is in D.C. We've got a real right to win in that area. There's a lot happening in national defense and in cyber. We're spending a lot of time there. We're spending a lot of time in healthcare, in medical products, and in pharma, in areas of innovation. And we're spending a lot of time in financial services, where we've got have had really good success, especially in the wealth channel and the democratization of wealth.
Well, Steve, we could do this all day, but I'm afraid we are out of time. Thank you so much for joining. Really appreciate you being very generous with your time. And with Sonali, with that, I'll toss it back to you. That's Steve Wise of Carlyle.
We appreciate it. That is our own Danny Berger at Superreturn. We're going to stick with private equity because Goldman Sachs is embarking on its most ambitious effort yet to offer an exit ramp for investors who've been trapped in buyout funds. Joining us now with the details, Bloomberg's chief Wall Street correspondent, Sridhar Natarajan. You know, it's interesting to me because on one hand, you have firms like Carlyle that are stepping out. They're trying to do deals. KKR spent gobs of money in the market downturn buying new assets. It's not the assets that they're buying that are the problem. It's the assets that they've held maybe since 2021 at the market peak that they have not been able to let go.
And the biggest clue for you was exactly what our Carlyle guest just said, that when you hear them talk about this yellow light environment or a lot of noise out there, that is code for it is a challenging market out there. And that has been the case for a lot of these private equity firms, and therefore has been very frustrating for their limited partners, for their investors, because it has operated in this time-honored cycle of investors will put in money into a private equity fund, get that money out, more money than they put in a few years, and are able to reinvest in new private equity funds. When any one part of that cycle breaks down, then you have a problem. And that's where we are, which is why we've seen this incredible explosion in secondaries.
Look at the chart here. I mean, we're seeing the explosion illustrated on your Bloomberg terminal there, from 26 billion in 2013 to 172 billion now. How much of a slice of the pie is Goldman taking from this?
Well, Goldman has had a big secondaries business. They have about $44 billion of a secondaries business. Off that, the private equity business, their flagship vintage fund had raised about $14 billion in its last iteration. It will try and top that amount for its 10th fund. So let's talk about 15 billion or more. It could still be challenging, but remember that a lot of these secondaries funds in the past used to directly deal with LPs, used to strike deals with LPs. Now what's happening is a lot of the private equity funds themselves, they don't want to sell off their stakes at lower valuation. So what they are doing is going into this new mode of financial engineering with continuation vehicles. So these so-called GP-led deals are becoming a bigger part of secondaries. One of the reports out there says that 60% of secondaries fund right now are participating in these GP-led secondaries than directly with LPs.
What's amazing to me is even in the lack of activity right now, when you see exits, you find this entire industry finding a myriad of ways to do a whole lot of business. Exactly.
Continuation vehicles, why not?
Let's keep that party rolling. Yeah. With that said, I want to ask you about what this all means for Wells Fargo, too. You have a bank that is on the brink of re-entering investment banking or doubling down in a bigger way. One of the main competitors still is the private markets. We know Wells Fargo was early to make a private credit deal. However, how are they going to navigate a market where the amount of competitors are now also rising in the non-bank space?
So let's set the backdrop a little bit for our audience, because what happened for Wells Fargo yesterday, the news out of the Federal Reserve, the fact that they no longer have to contend with that asset cap is a big deal. This finally means that they can get out of the gate and compete with the likes of JP Morgan, with the likes of Bank of America. They were shackled from doing that for the last 6 or 7 years. Now that opportunity is there for them again. Charlie Scharf has been talking about the fact that this is not the kind of environment where you go out all guns blazing. You don't just flip a switch and say you'll get big in everything. But their opportunities really lie middle of the fairway. More in trading, more in capital markets, wealth management, credit cards. They could finally go back there. When they were back in 2017, their assets were about $2 trillion. JP Morgan was 2.7. In 2025, Wells Fargo assets are still at $2 trillion. JP Morgan's at $4 trillion. They have grown their assets by about 60-70%. Bank of America by 50%. Everyone else has grown. Wells Fargo, therefore, has a great opportunity without having to worry about having to fend off these private markets rivals and peers.
It's like falling asleep and waking up in a different land, where JP Morgan was your one competitor. Now you have Citadel Securities and Apollo, too.
It's an incredible story. Sri, and great to have you as Chief Wall Street Correspondent to talk us through some of them. Sri Natarajan from the BN side. Tomorrow we'll be back at the Superreturn conference. It's a good one in Berlin, with more, including an interview from Thoma Bravo founder Orlando Bravo. This is Open Interest.
And I want to pull up a gold chart here for everyone, because we're watching gold up over 40% over the past year, bolstered by safe haven demand. Just last week, Goldman advised investors to turn to gold as a hedge against inflation. We're off the highs, but pretty close to them. And Matt, gold might be great if you bought it here at the lows, but if you are buying gold to make jewelry, this price appreciation might look a little differently.
Yeah, absolutely. It can have a real effect on an impact on your business. Let's get a read on how that gold spike, and maybe it's more than just a spike, is impacting the jewelry industry. Joining us now is Tom Nolan, Kendra Scott, CEO. Kendra Scott is a fashion lifestyle brand, continues its brick and mortar expansion, and obviously gold is a very important part of their business. Great to have you, Tom, on the program. It looks like the rise in gold prices may be here to stay. Bloomberg got a great story out overnight about central banks just buying in size, and they don't plan on stopping. So how do you deal with that as a CEO running this business?
I mean, look, there's so much volatility in the market right now. I think the 25-year high of gold was $3,500. We're not quite there yet, but it may be. I think the team's done a great job of hedging on the front end to make sure we have enough inventory on the raw materials and commodity side of things to protect the business, to make sure that we continue to have a high value proposition for our customers. At the end of the day, that's what we care about.
Does it make you force yourself to look elsewhere outside of gold? You look at silver prices, and they have risen over the past year also, but it doesn't look the same as gold. There's more volatility there. What do you want to do with that?
We want to do what the customer wants us to do. So, I mean, the customer said she likes and he likes silver, she likes and he likes gold. So we're pretty diversified across the portfolio.
How does the consumer look to you? And tell us first about your target consumer. So who are you after, and does he or she, or do they really feel like spending money right now?
Yeah, I mean, look, I think from a macro perspective, the consumer is in flux. I mean, there's a lot of noise out there. It's a very turbulent, tumultuous environment. Our customer is very diverse. We have my 16-year-old daughter loves our business. My wife loves our business. So does my mom. It gives us a lot of opportunity in white space, but it also makes it challenging because marketing to each one of those people and the constituents is different for each one. So, but we have a very broad base of customers. You know, consumer sentiment, as you all have reported, is challenged right now. But our businesses remain strong. We're up 6% through the first quarter. We're up 40% last year, 40% the year before, considerable EBITDA margins. So,
but who are you competing against? I mean, you're not, I imagine, going up against Cartier and Tiffany. I don't know that much about the jewelry business.
You're on the right track.
On the other hand, you're probably not competing with Kay Jewelers and Signet. So who is it?
You know, it's all the above. I think on the higher end, what we have seen with some of the consumer sentiment, people trading down into our fine jewelry business, which is very high quality. But it's everybody across the board, everybody that you mentioned. We only have a 10% national brand awareness here in the U.S. at a considerable size business that we are. So we've got a lot of white space and wood to chop as it relates to letting people know about who Kendra Scott is and who Kendra Scott, the person is. 23 years ago when she started this business with $500 at a spare bedroom of her house, has now become one of the wealthiest self-made women in America. So it's a great story to tell. We do a lot from a philanthropic perspective. We just opened our 153rd store. We launched a new brand called Yellow Rose last year. So it's been a really exciting moment for our business today.
You know, to the point that the consumer has been challenged, is there a price point that you find that people are gravitating toward?
You know, 84% of the U.S. population makes less than $150,000 a year. We're very cognizant and aware of that. I think there's a lot of focus on the very high end. We're talking about it here today, gold prices, diamond prices, some of the commodities. But we really focus on every customer, and they're our boss, right? So the sweet spot for us, our average ticket's right around $100. And we want to have a really high value proposition, and we want to create experiences. In our stores, last year we did 24,000 events, and the large majority of those events were centered around philanthropy. So we're giving back to the community. We're making and buying. Think about when you go buy jewelry or you're gifting jewelry for somebody. It's a memorable, exciting, fun experience. We want it to be that way. So retail has been really important to us. Our e-commerce business is strong. We've got great wholesale partners too.
How have the tariffs affected your business, and what are you doing, by the way? Do you have a war room set up? Do you have a weekly call? Does somebody give you a report every day? I mean,
it feels like since COVID, there's been like a daily war room that we've had to have for the last 5 years. It's just been challenging, but our business has done really well through it. So we're paying really close attention to it. I think the worst thing that you could do is make a lot of big material decisions in time of turmoil. So we're listening, we're paying attention. We're a very nimble organization. Our supply chain has changed dramatically since the time of COVID. So we were really well prepared for it. The team did a great job getting ready for whatever was going to come. And I think the thing that we've all learned is whatever you think is going to happen, you know, it doesn't stick with it. So there's constant change. So I think the team has done a great job of pivoting and listening to the customer, seeing what they want, and then reacting to it accordingly from price point and everything.
A couple days ago, we had a really interesting conversation about the movement away from real diamonds into lab-grown diamonds. And it really made me think a lot about consumer preferences and the change you're seeing from people in terms of what they consider to be great jewelry.
Yep.
What are you seeing?
I mean, the reality is a lab-grown diamond is an actual diamond. From a physical standpoint, it's the same makeup as same carbon makeup that a mined diamond is.
Sonali doesn't buy it.
So neither does my daughter, by the way. We were in our store in Soho yesterday, and we were talking about the store. She prefers mined diamonds as well. I think it's up to the customer. We offer both. The price point, you can't argue with, is significantly lower in a lab-grown diamond. And that suits some people, and other people choose mined diamonds.
Well, to her point, the lab-grown diamond doesn't hold its value, right? So if you're looking at it as an asset, which you can, as well as an emotional token of love.
What are emotions anyway?
Who cares about that? If you're looking at it as an asset, right, it just doesn't perform the same way. That's the difference.
I think so. If you were in the business of buying and then retrading diamonds, that holds true. I think for most people, there's an emotional connection to it. If you're getting an engagement ring with a 1.5 or 2 carat diamond in there, you know, I think some people may not be happy if it's a lab-grown diamond, but what we've seen is that emotional connection and the power that has of that moment in time matters more than the intrinsic value of what that thing would be if the marriage doesn't work out and they're trying to sell it in the aftermarket. So
key is not to tell her until then, right?
Yeah.
I say, hey, I got you a 3 carat diamond, and so many people died mining this.
Who knows, actually, that maybe the lab-grown diamond does appreciate in value.
I do think we're so early on this journey as it relates to lab-grown diamonds that could be the case. At the end of the day, it's a commodity. It's still not easy to get or make. There is scarcity value to it, and I think as long as that happens,
yeah, that's true.
Yeah, that's fair.
I'm learning so much about jewelry. She knows
Diamonds,
already.
gold, and silver.
Yeah, well, I learned a lot about it too. And the beauty of when I first started Kendra Scott, I didn't know anything about the industry. It's been a great learning journey for me for the last 10 years too, which has been great.
Very cool. Definitely a fascinating industry. Tom, thanks so much for joining us on the show. Tom Nolan, the CEO of Kendra Scott. You want to take a look at markets?
Yeah, let's do it, because it's been a fluctuating morning. We are looking at an S&P 500 now firmly up about 0.3%. It was interesting, Matt. We did see a dip lower a little earlier, so that tells me that, yes, generally we're seeing a little bit of bullishness. We're back in that bull market territory. However, it's on shaky ground. We had some weak economic data. That 10-year yield firmly below 4.4%.
What is it? It's June 4th. So it's pretty good timing for your new show, right?
Oh my gosh.
That we get into a bull market. Are we allowed to announce that yet? It's not yet?
We can tease the trailer, which is out tomorrow.
All right, so we'll watch the bullish trailer tomorrow when we close, hopefully in a bull market today. Let's get a look at some of the single stocks moving at this hour. Dollar Tree lower after warning about a hit to profit due to tariffs. So going the other way of Dollar General because they don't have as much access to or as much inventory of foods and groceries. Apple is getting downgraded over at Needham because of growth concerns in its position in the AI landscape. And then Chart Industries shares, as well as Flowserve, dropping after the equipment makers agreed to an all-stock merger that would create a company worth around $19 billion.
I thought of you this morning. I was going to say, I looked it up. It's really, if you really look at it, it's Chart Industries buying Flowserve. I came prepared with that for
There's always a buyer,
There's
right?
always a buyer.
Merger of equal doesn't really exist.
And Chart Industries will own more of the combined companies, but neither of their investors seem to love it yet.
Yeah, well, they don't like, the PR doesn't like to say that. Coming up, we're going to discuss how tariff uncertainty is affecting banking with Bruce Van Saun. He's the CEO of Citizens Financial, so we get the Wall Street look at Main Street next. This is Open Interest.
Thank you so much.
Over on Capitol Hill, the Senate has begun deliberations over President Trump's big, beautiful bill, and Majority Leader John Thune warns changes will have to be made to the SALT part of that legislation. For more, we want to bring in Kayleigh Lines, co-host of Balance of Power. And Kayleigh, we're also getting headlines from the Speaker, Johnson, saying that Elon Musk is dead wrong when he calls this tax bill an abomination and says it's going to add trillions to the deficit, and that he tried to call Musk last night, but Elon didn't answer.
Yeah, the Speaker said he did speak to Elon on Monday, and he said he would be trying to help Republicans keep the majority, I assume financially. But when he called on Tuesday after this tweet, I guess Elon Musk did not indeed feel like speaking with him after what was multiple posts on social media about the deficit impact this bill could have, which we learn more about from the Congressional Budget Office today, saying that it will add the House-passed bill $2.42 trillion to U.S. budget deficits over the next decade. That's because there's going to be a $3.67 trillion in the CBO's estimation decrease in expected revenues and only a $1.25 trillion decline in spending. And this is the very concern that even some Senate Republicans have, that these spending cuts do not go deep enough and the impact on the deficit is going to be too great, which is why Senate Majority Leader John Thune is going to have some difficulty navigating his majority here with those who want to see steeper spending cuts, with those who actually might want to see the price tag of this bill ultimately go higher, with being made permanent some of the tax cuts that are only temporary in the House-passed measure. That, as well as whatever adjustments need to be made to SALT, which Thune at this time is not getting very specific on, are likely to be discussed at the White House today, where Senator Thune, as well as members of the Senate Finance Committee, which is dealing not just with the tax portion of the legislation, but Medicaid as well, are going to be meeting with President Trump at the White House to try to hash out some of these details.
Kayleigh, I want to switch gears a little bit, too, because you are going to be speaking with Senator Elizabeth Warren a little later. And while on Wall Street, a lot of people look at the asset cap being lifted for Wells Fargo as a lot of joy and excitement, right? This is a big bank able to return to a lot of business. I do want to point out one of the more harsh criticisms I've actually seen of this from Jeremy Kress over at the University of Michigan online. He said the fact that it took Wells Fargo 8+ years to get its house in order and the Fed never escalated its punishment beyond the asset cap is a damning indictment of the current state of bank supervision. Now, the reason I bring this up is because we are about to see a lot lighter of a touch when it comes to bank supervision. Yep. Elizabeth Warren is kind of a lonely voice in Senate these days, fighting for more regulation at this point, isn't she?
Yeah, she is a minority voice. Granted, she does have a powerful one as she is ranking member of the Senate Banking Committee, but she's using that voice to largely agree with the tweet you just read out, Sonali, which is that she thinks this is an embarrassment, to use her language, of the Federal Reserve here. She says the entire Federal Reserve Board should be embarrassed by this outrageous giveaway to one of Wall Street's most derelict banks. She said the Fed needs to release reports into Wells Fargo from the last 5 years to the Banking Committee for review. We'll see if that happens. I'll ask her more about this later on today, but it does kind of point to to an overall attitude shift that Elizabeth Warren is trying to fight against when it comes to banking regulation. Obviously, we have seen a rollback already of the originally proposed Basel III endgame under the former Vice Chair of Supervision, Michael Barr. He is now no longer in that role, and we could see as soon as today the Senate actually making final the confirmation vote of Mickey Bowman as the new Fed Vice Chair of Supervision, someone who is widely seen, especially among Republicans, as being friendlier to Wall Street and someone who will have a more gentle hand when it comes to some of these regulatory issues. So we're watching for that later today. A cloture vote is expected this morning. If that procedural hurdle is passed, Mickey Bowman could be confirmed as soon as this evening, and with it could bring about a new era of banking regulation as Wells Fargo tries to move into a new era of its own now that its balance sheet is not going to be stuck at 2017 levels anymore.
Absolutely. The banks are very closely watching the Bowman era. That is Balance of Power co-host Kayleigh Lyons. You can catch Kayleigh's interview with Democratic Senator Elizabeth Warren coming up at 1 p.m. New York time. Do not miss it.
I hope she asks what she thinks the most derelict bank on Wall Street is. Because if Wells Fargo is just one, which bank does Elizabeth Warren hate the most?
She's gotten into very vocal arguments with Jamie Dimon, but interestingly enough, Wells Fargo moving out of things like home lending in a bigger way in the last couple of years and into those Wall Street businesses. But we're going to go right back to Main Street. For our Wall Street beat, we are now joined by Bruce Van Saun. He is chairman and CEO of Citizens Financial Group. Really good time here to really focus in on Main Street. What's happening with the American consumer? How do they feel, and how much do they actually want to borrow at this point in time?
Yeah, I'd say surprisingly, the consumer has been resilient through lots of uncertainty, kind of getting whipsawed by different policy rollout by the Trump administration. I think confidence took a dip in the beginning of April when the tariffs were first unveiled, but people still have pent-up desire to live their lives and spend money, and it actually, once we started to see off-ramps, that the worst case for tariffs was off the table. I think confidence has been restored. You've seen the latest consumer numbers are better. I think the next business poll will be better. And so I think the second half is actually setting up to be pretty good.
I wonder about the small business situation, even more than the consumer, right? The American consumer is pretty tough to knock over. But when this whole thing kicked off on April 2nd, we got so many emails from people running small businesses who said, like, I have goods on a ship right now. I don't know how much they're going to cost when they get to port. And, the small and medium-sized businesses are like, I think, 80% of the CapEx or 80% of job creation in this country. So how are they doing? You service those small businesses.
Yeah, I'd say it's a little tougher there. So certainly bigger companies have more diversity of operations and they can withstand some of these shocks to the system better than smaller businesses. But again, seeing kind of the off-ramp coming, one other thing I would point out is that we've been through a really tough period the last 5 years. So we had the pandemic that companies had to deal with. We had runaway inflation and the Fed raising rates very aggressively. Now we have the introduction of tariffs. I think businesses have become very resilient and very adaptable, and they do scenario testing. They try to think through, how do I have multiple supply lane chain scenarios so that I can deal with what comes down the pike. So yeah, it's been challenging in the here and now, but I think most businesses we're finding are still having reasonably good years and are optimistic about what's going to take place later in the year.
Do those businesses really need lower interest rates at this point? You've seen rates stay at this level generally for a while now, and things have held up.
Yeah,
so what do you feel about the need?
A lot of businesses locked in lower cost financing over the course of the last 5 years. So they've got their balance sheets in pretty good shape. And so I think that hasn't been a big worry.
I wonder about the level of tariffs, because a lot of, I guess, pragmatic business people come in here and say, look, if we get 10% as a baseline, that's okay, especially if we're getting the tax cuts and incentives to go along with that. On the other hand, I was thinking about this yesterday. 10% is European tariffs on U.S. cars, and it's been enough to effectively lock out U.S. manufacturers from the European car market. So how much is too much?
Yeah, it's a good question. I think the Trump administration is playing for some long-term gains. I'm kind of excited by the fact that some countries are now saying the end game should be let's lower tariffs. That's what Europe is saying. We should have lower tariffs going both ways. Let's negotiate towards that outcome.
That's true, but this president wants to have tariffs to replace tax
I don't know.
revenue.
Like, is that the primary objective? He wants fairer trade. So India's making that proposal as well. It would be good if we can reach a harmonious outcome with our friends, and then actually isolate China as the last big nut that has to be cracked. So anyway, I think you're starting to see some steps in that direction. But again, I think the tariff thing will resolve itself. The worst case outcomes are off the table. The market is looking forward to tax and spend bill passing, towards regulatory nominees being confirmed, the deregulatory agenda moving forward, pro-energy policies, pro-business policies. There's a lot of pent-up demand to do deals. Private equity has to recycle capital. So again, I'm staying optimistic, cautiously optimistic about the second half of the year.
What about the tax bill? You look at the Congressional Budget Office saying that the tax bill would add $2.4 trillion to the deficit. You have Jamie Dimon warning about a crack in the bond market. A lot of concern about the longer-term interest rates that we're seeing that have close ties to a lot of American financing, mortgages and otherwise. Yeah. How concerned are you?
Well, I think extending the tax cuts is something that had to be done. I think the amount of spend in this bill is less if the Republicans stay unified than if they crack, and then they have to go to the Democrats to get the bill passed to extend the tax cuts. So, it's not ideal, but the legislative process is messy. I think we can absorb the spending that's in this bill. I think the administration thinks that they can grow their way out of some of this deficit by faster growth. So that's the play right here, is to try to create the conditions that the economy picks up its growth rate, and then all these debt to GDP ratios fall back into line.
Bruce, we are so lucky to have you today. It's very interesting. A lot of investors really banking on that pro-growth part of the story. Let's see if we see it. That was Bruce Van Saun of Citizens. And it's Countdown to Bullish. My upcoming series for Bloomberg Originals is coming soon as the S&P nears a bull market. We're going to talk a little bit more about that. Excited to bring you those guests on this show soon. Stick with us. This is Bloomberg Open Interest.
Let's get a quick check on the markets. Right now, looking at the S&P 500, 59.81, 59.82, so up 0.2%. We are back in a bull market now, coming back 20% from the lows that we closed there. It's going to be perfect for your new show.
Yeah, bullish just in time for bullish. But, interesting to me still is that you have a little negativity, too. You have worries in the dollar still, worries about the fiscal situation. You're not seeing that in the bond market, though, today either, that 10-year lower.
Yeah, absolutely. Worries about deficits. And I think people aren't as concerned about a 10% baseline for tariffs as they should be. The damage that did to the U.S. Car manufacturing industry in Europe is maybe irreparable. So I think something to watch.
The big moment of the week also still jobs on Friday. But tomorrow we have a great lineup for you. We're going to talk to Morgan Health CEO as well as a group of investors. Stick with us for that. This is Bloomberg Open Interest.